Hey, Tyler, it's time for us to talk about some more dividend stocks. There's a couple that you brought to the show that we're going to talk about today. One of those is a stock that you think investors should, well, kind of staying away from right now, avoiding. The other one's a stock that you think investors should be buying hand over fist. You ready to have that conversation?
You know, yield is always a tricky mistress to deal with. And so sometimes you have to take the good deal and sometimes leave away what may be a great deal because it could leave you in the dust. And that's what we're going to talk about today.
That's exactly right. That sometimes the great deal is actually the really bad deal. I'm Jason Hall. This is Investing Unscripted. We're going to talk more about exactly what that means. But first, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, besides the two stocks we're going to talk about today, check out our special link. It's fool.com/unscripted. Go to that link, put some information in, and The Motley Fool is going to give you 10 stock ideas. They're going to give you their 10 best stocks to buy right now. Again, fool.com/unscripted. Be sure to check that out. Okay, Tyler, I think what we should do is people need to eat their vegetables. So let's start out with the first stock that's on your investors should be avoiding it right now list. And then we'll talk about the one you think investors should be buying, like maybe even buying a pretty large amount of, because it's a great alternative to the one you think that we should be avoiding right now. And that one is Next Year Energy Partners.
As tempting to anyone that looks at a stock that has a 12% dividend yield. I mean, look, if you can get 12% every year and you know you're going to get it, that's like take that to the bank. But typically when you see a dividend yield that high, it normally means something is wrong or the market sees something wrong.
I'm going to bring
That's
it up on the screen right now. Over the
we've
past
covered
year, you see
we've
the yield has moved up a ton. The
yeah,
stock price has moved down a ton. This isn't a case of the growing dividend. This is a case of investors are really concerned about something that the management is telling us.
yes. We've talked about this in previous videos, iterations quite a bit. So I don't want to cover this too much, but the gist of it is that the cost of capital for NextEra Energy Partners is getting really expensive, and they have a lot of debt coming due right around now, especially low cost of capital convertible debt that, isn't going to convert at the prices they were expecting, which means higher cost of capital. NextEra Energy Partners was very much designed to be a low cost of capital investment vehicle for the NextEra Energy, its parent company. But when its cost of capital raises, its a reason for existence becomes a little bit less secure. At this kind of dividend, the market is more or less saying you can't really afford to pay your dividend anymore, at least at the current rate and at the rate you say you're going to grow it. And I tend to agree. Like we said, we've talked about it before, that the amount of money going out the door is just, it's unsustainable, especially after some recent asset sales. So with all of those things said, it just doesn't look like a 12% yield that you can like bank on. I think there's a relatively good chance that we see a dividend cut.
Yeah, I'm gonna play the devil's advocate right here because I still own some Next Era Energy Partners, and I agree with you. I think that generally most investors should probably be avoiding it because, like, the degree of difficulty to execute what management is saying they're going to do, and that they've laid out this plan to say, well, hey, here's how we can grow our cash flows. Here's how we can grow and afford the dividend, even raise the dividend. Like they've laid it out there, but the degree of difficulty to execute it is incredibly high. And as a result, if you are an income investor, if you're buying a stock based on expecting to get that check from them every quarter or every month, depending on how they pay it out, you're risking a huge pay cut by investing in this company. So that's the risk. Now, if you're somebody more like myself that you're seeing, there's a little bit of an interesting risk reward profile where maybe they can actually, if they deliver it, there's upside, then I could see maybe holding or buying a little bit. But generally, I think Tyler's spot on here. Tyler, let's talk about your stock that you're bringing to the video that you think is absolutely a buy right now. And this is great because this is one that in the past you've been a little kind of maybe leery of, and that's Brookfield Renewable.
Yeah, so in the past, I've been leery of Brookfield Renewable for two reasons. Number one, I think some of the ownership stuff's a little complex and it's a little hard to understand. It's kind of like the Russian nesting dolls where like a bunch of stuff is packed in
The little
together.
nesting dolls, right? Yeah.
Yeah, so that still exists and it makes it hard for me to wholly understand what's on the books at Brookfield Renewable. However, the other reason that I was tepid of it was largely because of valuation. And there was a time not too long ago, 3 years ago, where this had a dividend yield of something like maybe 3%, maybe a little bit less. And this is a business that for years, of pretty much its entire existence, says we're going to grow our payout about 5 to 9% year over year. And that's going to be our target. And at a yield that low, that just the math didn't quite add up for me in terms of total return. Today, as we speak, we're getting closer to almost a 6% yield. And so when I start doing the very quick napkin math, I have a 6% yield plus a, 5 to 9% growth rate on that yield on the payout. All of a sudden, that's, rough math, that's like 11%, right? That is a little bit more commensurate with the type of like long-term annualized returns I want to see from an investment like this. Brookfield's never going to shoot the lights out. It's never going to, double in a year. It's never going to, it's never going to moon. It's probably never going to be a meme stock. It's going to be a slow growing business. And when that is the case, you need to be more sensitive about valuation. And this is a time I understand that cost of capital is rising for everybody, but Brookfield is one of the rare cases where when cost of capital is higher, they tend to do better. There's going to be a lot of companies and a lot of assets out there that are going to get distressed because of higher interest rates. I think we're in a period where interest rates could be higher for longer, and it's going to put a lot of strain on these
Mhm.
assets. And when somebody needs to go hat in hand to find a way to pay for these, Brookfield is going to be one of the well-financed entities that's going to be able to take them off their hands for pennies on the dollar. They did it with Sun Edison like several years ago with the Terraform Power, Terraform Global. They did it with Colombian hydro assets back in the early like 2000s. This is basically how this business was built. And so
That's it. You look at I brought up the slide here, and you look at every one of their operating units, and that's how it was born, right? With
yeah,
those Colombian hydroelectric assets. And then the wind and solar, the beginning of the utility scale solar and wind was the Sun Edison bankruptcy and being able to pick up the assets you mentioned. More recently, the distributed business that it's moved into, not quite a fire sale, but they saw some opportunity because of the economics. That's their story, right? That's their story. And the other part of it too, Tyler, because I agree with you that this has become really high on my radar too, and it's one that I've owned for a very long time, is the difference in the relationship with its parent company that Brookfield Renewable has versus Next Year Energy Partners. So we've talked about it ad nauseum that Next Year Energy Partners is a finance mechanism, right? It's a way for Next Year Energy to have access to these cash flowing assets, but get the debt off of its balance sheet, right? To manage its balance sheet because it's a regulated utility and unregulated. So it helps it by having that entity. Brookfield Renewable exists for a different reason. It's got Brookfield Corporation, its parent company that owns more than half of it, that also operates Brookfield Asset Management. Brookfield Asset Management manages hundreds of billions of dollars in alternative assets, and it needs kind of an operating partner for a lot of those assets that it acquires and a co-investment vehicle. It's not a drop-down vehicle. So the economics are very different. And the role that Brookfield Renewable plays with its partners at Brookfield Asset Management and its parent company, Brookfield Corporation, is a different role that allows it to be successful no matter what the operating environment is, the interest rate environment. And like you said, Tyler, I agree 100%. Their legacy as long term buyers, they're not following the market's cadence. They're not chasing a quarterly number. They're trying to create value. They'll sell an asset when they can get a premium for it and it doesn't meet their growth profile over the long term and sit on the proceeds from that as long as it takes for the right opportunity to come along to deploy it at their price. So I think you're absolutely right that the market's created an opportunity.